conflict. And therefore, the last place that you're going to find truth is in large groups. I hope Samvad is an exception. That 2024 was a year of many parts, and many parts of the world, I think, were under significant strife, and thousands of innocent people lost their lives, I think, in 2024. But I ran into this beautiful insight from Gulzar. In a book I picked up when I visited Amritsar and the Partition Museum during the Christmas break. And this was from a book called Divided by Partition, United by Resilience by Malika Ahluwalia. And for those who don't know Gulzar, Gulzar was born in Dina in Jhelum, which is now in Pakistan. And he grew up as Sampuran Singh Kalra, as a young boy of 11 in Delhi during the years of partition. But I think he was old enough to, go through that agonizing time and those images of corpses lining the streets of Purani Delhi. And Gulzar says this of partition, and I think it's true of everything that we see in the geopolitical conflict that we see in this world today. Countries can be divided, land can be divided, but you are dividing people, you are dividing cultures. These cannot be cut. How will you partition air? The trees that were divided will grow again, and their shadows will fall on one side of the border in the morning and on the other side of the border in the afternoon. There is no use cutting shadows. And that left me wondering, where will all this geopolitical conflict lead us to in the years to come? Another book that talked to me in 2024 was a book called AI 2041 by Kai-Fu Lee and Chen Qiufan. As a genre, you could call this book a, eco-techno thriller, as some people say, or maybe even future science fiction. And, the opening story of this book is set in Bombay, and it is about a family who signed up for a deep learning-enabled insurance program. And it's a story that revolves around a company that drew inspiration from Agastya Muni and used artificial intelligence to perform deep learning, auto-translation and analysis. So what this company used to do was, it picked up all the Nadi leaves, and for all those people who, are followers of astrology, they'll know that Nadi are those palm leaves where everybody on this universe future is written on, and from which you can read their, everybody's past is written on and you can read their future. And it sort of created 8.7 billion Nadi leaves for every single individual in this world. So that's what the story is about. But I think the insight I got was not so much from the story, but from the commentary that Kai-Fu, gave after the story, where he says that beyond internet companies, the next industry that is low-hanging fruit for artificial intelligence is finance. Artificial intelligence based on fintech companies are poised to overtake the brick and mortar financial companies because they deliver better financial results, instantaneous transactions, and lower costs. Another benefit of AI tech is that they can use data beyond those considered by human professionals. It can improve predictive power by tapping into massive heterogeneous data that would not be feasible for humans. I don't think this is 2041. This may be as good as 2026 for all of us. 2024 was also a year where I had some, great insights and fascinating conversations with many of the gurus of the securities market. But two insights, stand out in my mind in all those conversations. One was a conversation which I had with Professor Jayant Verma of IIM Ahmedabad, and he reminded me of something. He said, markets are efficient most of the time, and therefore one should start with the presumption that market is efficient. If you want to refute this, you must have strong evidence that markets are mispricing a stock. You must do an enormous amount of analysis to come to that conclusion, and that stock is underpriced. This cannot come from a gut feeling. as the chances are that the market is much more efficient than your gut feel. The efficient market hypothesis, therefore, is primarily a prescription of humility, saying that however smart you may be, chances are that in most cases, the market has already figured it out. Another very counterintuitive insight that I got, and that was given to me by Lalit Kesari of Grow, was when he told me, when we started our business of online distribution of mutual funds, we were advised to follow the traditional process where one would ask a potential investor to, a set of 10 questions, and then based on the answers to those 10 questions, we would advise her on which mutual fund to buy or invest in. But our approach was to give the customer the choice of all the 5,000 mutual fund schemes. Every conceivable information on every single fund was made available on our platform to our investors. It was a very counterintuitive idea that we should offer so much of choice and not be driven by the need for conversion. We found that offering complete choice engendered customer trust. If you open everything to a customer, the more he trusts you. Transparency overpowers choice paralysis. And I found that very, very intriguing. In conclusion, yet another thing I learned from 2024 is that Samvad or consultation has to become a way of life. And I think what better example than SEBI for that? In 2024, SEBI put out 20 consultation papers, close to, I think, 2 papers a month. And to quote Madam Chairman, and this is a disclaimer, I am not trying to steal words from her. She said that SEBI's goal is to engage with stakeholders rather than to react to issues after they arise. So much so that, in a very amusing side, she also said that, SEBI didn't want to be like that police person we see in Bollywood movies who enters a scene years or maybe months after the mischief has already been done. So thank you so much for being here today, ladies and gentlemen. I mean, this, I think, is exactly what Samvad is all about. Thank you.
Thank you so much, sir. It was an absolute privilege to listen to your thought-provoking words today. Your perspectives have set an excellent tone for the discussions ahead. Our keynote speaker for the event is Mr. Setty, Chairman, State Bank of India. He will be addressing us virtually. Sir, we look forward to hearing you.
Yeah, good morning, Dr. Suman Bery, Srimati Madhabi Puri Buch, Sri Ashish Chauhan, Sri Seshi Krishnan, and other distinguished guests. I want to thank SEBI and the NISM for inviting me here today for the keynote address. Also my apologies for not being present here physically for this very important event. My compliments for both for NISM as well as SEBI for organizing this Samvad. So I would like to share a few thoughts in terms of, the theme capital for growth, both in terms of what capital markets can play in terms of contributing to the growth capital, the increased requirements of growth capital. So if you see, Indian capital markets have a history of more than a century. However, they remained largely inactive till the 1970s. Post the economic liberalization in the early 1990s, India's capital markets have witnessed transformative growth, enhancing access to funding for businesses across sectors and sizes. India's market capitalization today has surpassed, as Chauhan has mentioned, about 450 lakh crores, with over 7,500 listed companies, making it one of the most diverse markets globally. Today, segments of India's capital markets are comparable with counterparts in many of the advanced economies in terms of efficiency, that is basically price discovery, tradability, which is low impact cost, resilience, which is co-movement of rates across product classes and yield curves, and stability. Well-functioning capital markets are critical to accelerate the sustainable economic growth needed to broaden prosperity and reduce poverty. Deeper and more efficient equity and debt markets can be more effective in helping to mobilize and deploy domestic savings, thereby complementing traditional bank lending by fostering long-term investments. Further, vibrant capital markets can protect Indian economy from volatile fluctuations in capital flows and reduce the dependency on foreign debt. Capital markets also promote transparency and governance and provide diversified sources of investment to savers and corporates. India today has all the diverse drivers in place to foster deep and well-functioning capital markets. These drivers include macroeconomic stability, market autonomy, fair and efficient legal and judicial systems, efficient regulatory regime that creates conditions favorable for financial contracts and investor protection, easy access to high quality material information, diversity in investor base, efficient market ecosystem for trading, so on. So Indian capital markets have deepened significantly with domestic institutions like AMCs and insurance companies commanding significant AUMs, thereby serving as a significant counterweight to foreign capital flows. Today, there is significantly greater access to far deeper pools of capital than what it was a decade ago. The Indian asset management industry today has an AUM of 63.5 trillion rupees compared to 1.13 trillion in FY 2000, a massive 60x increase. Mutual funds have emerged as key players in Indian capital markets with monthly SIP contributions exceeding 25,000 crores. I think the December number says 26,000 crores, showcasing rising domestic interest. Foreign portfolio investors in FY24 contributed net inflows of over 2 lakh crore Indian capital markets with a focus on sectors like financial services, capital goods, green energy, and healthcare. Some outflows are definitely balanced by the domestic inflows. Demat accounts have surpassed 17 crores, with majority of new accounts originating from Tier 2 and Tier 3 cities, marking a shift towards more inclusive investing, with retail investors contributing directly as capital providers to build India. The calendar year 2024, that is till November, saw 76 IPOs raising 1,34,000 crores across sectors such as automobiles, renewable energy, financial services. QIPs contributed 1,23,000 crores, supporting expansion, mergers, and deleveraging efforts. The record volume of equity issuances and the ability of the capital markets to absorb this significant supply of paper provides confidence that Indian capital markets today supplement banks and institutional lenders to fund capital needs of India. The richness and maturity of Indian capital markets is further reflected in the fact that Indian capital markets have come up as an alternative where the global corporations are looking at to list their Indian subsidiaries, making India possibly the only non-home jurisdiction where such MNCs list their subsidiaries. The derivative segment, of course, of the Indian capital market has also become one of the largest in the world. NSE remained the world's largest derivatives exchange for the 5th consecutive year in 2023. It ranked 3rd in the world in the equity segment by number of trades, in 2023 as per the World Federation of Exchanges. Now coming to the funding perspective, financing growth from banks' point of view entails assessing two questions: availability of growth capital and garnering enough lendable resources to fund growth. At the macroeconomic level, for the first leg of Viksit Bharat, that is time horizon up to 2036, we envisage a growth rate of at least 8 to 9% on average. This rate can be achieved if we can increase the investment rates to 35% by 2036, approximately 200 basis points higher from the current levels in 2024. Thus, the domestic saving rates must rise from the present level by at least 350 basis points to 33.5% so that CAD stays around 1.5% of GDP, its long-term sustainable level for India. This back of the envelope calculation shows that capital markets must gear for additional supply of savings to the tune of 3.5% of the GDP over and above what is presently coming in as annual inflows. Further, we must keep in mind that these incremental flows will come from a segment that is young, who have a different risk appetite and outlook on investment. It is important that institutional arrangement such as the mutual funds and primary markets look at this as an opportunity so that these savings are channelized into productive sectors of the economy and do not flow into derivative segments, as has been the case in recent years. This also calls for greater focus on investor protection and investor education. On the demand side, we find that higher investment rates of 35% will require at least 127 lakh crore of funds in corporate bonds, assuming the size of the corporate bond market at 30% of GDP. At the conservative level of credit to GDP ratio of 75%, the cumulative funds from the banking system amounts to 323 lakh crores. So when we aggregate all the sources of external finances, bank borrowing and corporate bonds, then at 70% debt to equity ratio, we need equity mobilization of 643 lakh crores by 2036 to support the envisaged growth by 2036. This is something, which we need to ponder how this depth in the equity mobilization is achieved. Another area which will need special focus in India are obviously the MSMEs and their need for capital to propel India's growth, especially in light of the Make in India initiative, where MSMEs have an important role to play. MSMEs already contribute almost 1/3 of India's nominal GDP and account for 40% of our exports. Most importantly, they're also a major employment generator in the economy. Traditionally, a big challenge in providing credit to MSMEs has been the lack of credit information and information asymmetry created due to it. Many MSMEs tend to lack proper financial records or the financial resources to get external credit ratings. On the equity side, the SME platform has made significant strides in becoming a viable alternative for the MSMEs to raise equity capital. But due to these limitations, it becomes challenging for banks as well as the public debt capital markets to properly price the risk and hence to lend to these SMEs. There are a lot of data points which are available now, whether it's the GST or the bureau data, which is making the lending to MSMEs to that extent much easier now. I'm sure in the equity markets also, these data points will help in structuring the equity offerings. In recent years, fintechs and banks have started to dig for credit information from publicly available data and using analytics to create a credit profile. For instance, SBI has launched a business rule engine based credit assessment for SMEs, which is end-to-end digitalized process depending on the data available. And today we are able to give an in-principle credit approval in 15 minutes to an SME. So RBI has also made important contributions like the TREDS facility, which allows an MSME to access trade receivables financing through an electronic platform. But for greater involvement of capital markets in funding these important pillars of the economy, we will need to find a way to formalize and collate all these disparate sources of information and create a repository to enable investors to correctly price the credit risk on these MSMEs. In addition to this, we will require a viable mechanism to track the actual use of these funds to ensure that the funds are utilized for the purposes they have been raised for, probably through the establishment of a separate market infrastructure institution with powers to track the use of borrowed funds or the funds raised through the equities. This will provide comfort to lenders as well as investors to make pricing more competitive. Furthermore, these calculations do not include the need for climate finance and green transition. Estimates suggest that annual green financing requirement could be about 2.5% of GDP to address the infrastructure gap created by climate events, which could increase if faster carbon emission reducing goal has to be pursued than what is committed under the NDC, Nationally Determined Contribution to United Nations Framework Convention on Climate Change. It is estimated by the Council on Energy, Environment and Water that a cumulative investment of US $10.1 trillion is needed in India to meet net zero commitments by 2070. Of this, $8.4 trillion investment is needed to meet power sector transformation, shift to renewable energy alone. Industry will require 1.5 trillion and the mobility sector is estimated to need about $198 billion. Thus, when we reflect on these projections, we have to objectively assess that there are institutional gaps that need to be bridged to mobilize these funds with minimum possible impact costs. Developing a requisite market and achieving self-sufficiency in financing growth is important in a world that is rapidly undergoing geo-economic fragmentation. So what is the way forward so that India becomes self-sufficient in efficient mobilization of savings through capital markets? To my mind, there are some areas we need to work upon. First, we need to widen the pool of listed companies and encourage more spot transaction for price discovery. The reliance on derivatives is not the best way to achieve depth and liquidity. To this end, the recent measures by SEBI to curb the access to derivatives is definitely a step in the right direction. Second, we must devise mechanisms so that private placement gives way to more open offers. Third, we must strive for better use of technology to reduce costs and also enhance investor education. Fourth, strengthening investor protection and how the investor protection fund should evolve under emerging circumstances. Developing capital market is a long-drawn process. Only when we evaluate our successes and look to improve gaps will there be a chance to improve. I will conclude my address by summarizing my position. Capital markets are indispensable to the growth of any country. The importance of capital markets to achieve the ambitions of Viksit Bharat is critical. The vision of Viksit Bharat requires mobilization of funds, as I mentioned, and if you summarize, to the tune of 1,094 lakh crores by 2036. This creates challenges and also opportunities to develop markets both from buy side and also sell side. Looking ahead, capital markets need to play an even bigger role by mobilizing more private capital for key sectors with financing needs to power future economic growth, including infrastructure, housing, SME, and many other sectors that create impact. Developing capital markets successfully requires a supportive institutional, legal, and regulatory framework for institutional and retail investors, as well as the issuing companies and banks. For such frameworks to develop, a highly coordinated approach is needed. It requires a wide range of experts and involves a large group of different stakeholders. That includes central banks, ministries, regulatory agencies, market infrastructure providers, the private sector, and non-sovereign issuers and investors. In addition to the enabling framework, well-functioning capital markets require strong capacities in asset, risk, and capital management. Today, we have a world-class market regulator in SEBI. SEBI has put in place several initiatives and policies to ensure capital market stability and instill confidence among stakeholders and minority shareholders. There are several initiatives I can mention here: liberalizing the process of innovation of new products, putting in place comprehensive market regulations by addressing gaps, in particular by issuing market abuse regulations, as well as regulating the market ecosystem, so many other things, including efficient disclosure regimes to ensure equitable access to material information across all invested categories, and deepening of the domestic institutional investor base, complementary markets development, including F&O and derivatives, and so on. By prioritizing these areas, India can sustain its trajectory of capital market growth, fostering innovation, inclusion, and economic resilience. So I once again thank SEBI for the invitation and giving me an opportunity to share my thoughts, and also thank the audience for a patient listening. Thank you very much. Have a wonderful day ahead.
Thank you so much, sir, for your enlightening words. Next, we have the honor of inviting our chairperson, Ms. Madhabi Puri Buch, whose leadership and vision has been instrumental in shaping India's securities market. This is the
Mic is on. Check.
Dr. Bery, Mr. Setty, Ashish, Shashi, and all our friends of the market who are here, 300 of you present here, and I'm told another 1,700 online. It's really a pleasure to be here. And I must say that as I heard Mr. Setty speak, I was getting more and more worried because SEBI today faces a lot of criticism that we are moving too fast and that the industry and the ecosystem is not able to keep pace with us. And yet the ambition of the nation, as outlined by Mr. Setty, demands that speed. And it demands that if we have to realize that aspiration for our country, which we know is within reach, we know it is within our grasping distance, we do need to move with speed. So I'm very grateful to Mr. Setty for setting KRAs for all of us. So here's to nation building. The subject today is capital for growth, and I would like to hark back to a statement I made many years ago to say that the purpose of existence of SEBI is capital formation. So to me, it's really déjà vu to say that today I have this wonderful opportunity to be standing here after roughly 3 years and to be able to be addressing a generation of people in the market who have been so fortunate that the entire universe has come together over the last many years to help us to grow in the way that we have as a nation grown. Whether it is the government policy, whether it is the entrepreneurship, whether it is the regulations, whether it is the markets, all of it has come together to create a wonderful ecosystem that not only has demonstrated the growth, but has built such a strong foundation for future growth. So it's a privilege for us as the markets to be facilitating the growth of the nation and the real economy of the country. And we've had a wonderful run. So while looking back, and this was something that a very, very experienced administrator once told me, she said, you know, Madhabi, people like us, we see so much opportunity going forward, and we have so much we want to look forward to, that we sometimes forget to look back to see how far we've come. So, honoring that sentiment, I would like to recap some numbers. Many of them have already been shared. But as a backdrop to what we believe in SEBI is what is actually possible in the future. So, in terms of equity raise, everybody is familiar with what happens in the IPO market. I think what sometimes goes unnoticed, the IPO market is the green stack there. What sometimes goes unnoticed is the preferential issues and QIPs, which really add a significant number. So if we look at today, just in the last 9 months, 3.3 lakh crores of equity raised just in the last 3 months, so in the last 9 months. So you can safely assume another lakh for the balance quarter. So we'll be roughly at about 4.3 lakh crores at the end of the year. Now, one of the steps that we have taken recently is to try and increase the orange bar there, which is the rights issue. We have come up with a system of doing a fast track, very, very fast track rights issue, which can then be followed by a preferential allotment for the amounts that are not taken up by existing shareholders. And the total end-to-end time for actually doing this is the shortest amongst all the stacks and is under 26 days from end to end. We do hope that industry will use this extremely fast track, which not only gives speed and lower cost of raising money, but also gives the right of first refusal to the existing shareholders, and that is what the shareholders will bless all our companies for. Equity itself is only a part of the overall fundraise in the markets. So this again is a statistic that is sometimes forgotten. So if we look at 24-25, again just the 9 months, we are already at 10.7 lakh crores overall capital formation, because the debt market, the primary debt market, has raised 7.3 lakh crores, which is sometimes an under-reported number. And if we project for the next quarter, we'll probably end somewhere like over 14 lakh crores raised for the year in terms of capital, both equity and debt. Looking forward, our view in SEBI is that the green stack, which is actually very slim at the moment, the REITs and InvITs, and I would actually personally prefer to put muni bonds there as well, we believe that the potential for this green sliver to grow over the next 10 years is so significant that it could not only match the 7.3 and the 3.3, but it has the potential to exceed that. So we believe that that's the kind of opportunity that our market has, and if we collectively really put our minds to it, the kind of assets that we have in this country, not only the existing assets, but the ones that are yet to be built, together can actually double that stack there with that little green sliver which is there today. All of this is partly assisted by direct investments by investors, both retail and institutional, and partly through pooled investment vehicles like the mutual funds that we run in our country. The growth of the mutual fund industry is now legendary in our country, and I would only say that I would want to compliment the industry and its association, because what they really did over the last many years, 10 years I would imagine, is they have built such a strong foundation of good quality of governance, good quality of disclosure, good quality of responsiveness to the investor, that they have been able to log this growth, working in full partnership with the regulator to strengthen the foundation on which the superstructure has been built. So if you look at the way the mutual fund AUM has grown today, we're almost 67 lakh crores. The number of mutual fund folios has also grown very significantly. Number of SIPs has grown very significantly. And equally importantly, if you see the yellow line, when we talk of financialization of savings, we look at how the number of AUM as a percentage of bank deposits has grown from just under 16% to over 30%. So over this period, it's been almost double, and perhaps by the time we end this year, touch wood, that might be the case. So the reality today is that more and more of our citizens are participating in the wealth creation of the nation. They are benefiting from the wealth creation of the nation, and that is something that gives us huge amount of inspiration. So if we look at the investor base, now these are, the blue line is the number of unique demat accounts, right? So this is not accounts, but unique accounts. So we are at about 11 crore, yes, this is in crores, 11.5 crore unique demat accounts. The total number, of course, is much larger at 18.5. That's because people have joint accounts with various family members, etc. And the total number of unique mutual fund investors is 5.3, roughly about half of the total number of demat accounts. So we are looking to see even further penetration of the mutual funds amongst the investor groups. And we believe that, Mr. Setty has been very, very gracious, not only as a person who, of course, is overall responsible for SBI Mutual Fund, but for the entire group and the bank, that he would actually assist the SBI Mutual Fund to popularize the low-cost SIP, which is the 250 rupee SIP, popularize it across the width and length of the country. And when you have the banker to every Indian pledging that support, we believe that there's no way that that won't happen. So Mr. Setty, thank you very much for all your support, and we look forward to taking this number of unique mutual fund investors to a very, very large number in very short order. The overall impact of this, as has also been said earlier, is the kind of resilience that our markets have seen on account of the fact that our domestic institutions lend such a strong countervailing force to the global, I would say, trends, which sometimes are negative or sometimes flat. So when you see foreign money, it sometimes goes the blue bands. They sometimes go up, they're sometimes flat, they're sometimes negative, as we have seen in the Q4 of calendar year 24, so up to December. And yet what you see is the countervailing force of the domestic institutions through the orange bars. And that is what has given tremendous resilience to our markets. And that is one of the most attractive features of our markets for foreign investors as well, because they know that if and when they have to leave, the impact cost of leaving is very low. And the fact that despite headwinds globally, the resilience of the Indian markets will continue to deliver returns to them because of the strong domestic demand. It is because of this that we find that the benchmark index, really on the strength of all of this investor trust, has been going up, and in just a very, very short period, we have seen it going up from a level of 9,000 to almost 24,000, and of course there have been a bit of volatility there, but clearly the direction is completely a very, very smart slope, upward slope. A concomitant repercussion of this, a positive repercussion, is India's weight in the MSCI Emerging Market Index has been steadily increasing, and we are just under 20% now. And this has huge implications for us as a market, because what it means is that the global global passive funds which are there globally and which have a very dominant position in global markets, when they choose to invest in the emerging markets, we get an automatic share of almost 20%, and that money just flows automatically into our ecosystem. So this is something, again, that as a country we are very, very proud of. And for a moment now, going to the bonds, because, you know, a lot of discussion on equity, but we saw that the bond market in India also is very, very large and contributes a lot to capital formation for the economy. So what we are seeing here is the chart of, if you take all the outstanding corporate bonds and you compare them to the outstanding bank credit to the corporate sector, this is the proportion. So this is often not understood, that the bond market actually contributes almost $60 for every $100, or 60 rupees for every 100 rupees that the banking system gives to corporate India. So the primary market of bonds in India is very, very strong, and there's a huge amount of capital formation that is happening there. The reason we don't see a lot of that result in secondary market trading is because most of the investors are buy and hold investors. But it leads to significant capital formation, and this is the kind of growth that, and the kind of role that the market needs to play in terms of capital formation going forward as well, if we are to meet all the aspirations that were outlined by Mr. Setty as a nation. What is the role that SEBI has sought to play in all of this? As I said, we are a very fortunate generation that the economy, the government policies, the ecosystem, the corporate sector, the entrepreneurs, everybody has contributed to this growth. Our little contribution to this is that when there is capital formation, SEBI should be a facilitator and should not be coming in the way of capital formation. In fact, it should be a facilitator. So we have been tracking that what is the aging and pendency of public issue applications with us over all of these years. And as you can see, when there is high pendency, it's actually a good thing, because it means that there is so much activity in the market. In fact, these days, you know, almost on a monthly basis, we are flooded with IPO applications, which is a very good thing. But as you can see, the aging has been brought under control by SEBI through a huge amount of effort, in recognition of the fact that when markets are good and companies need to raise capital, they cannot afford to wait. And therefore, end to end, this metric is calculated by SEBI, I have articulated before, from date of first application. In SEBI, we do not allow ourselves the luxury of saying that we will compute aging from the date of receipt of all information. We don't allow that, because that's a very convenient way that usually we as bureaucrats can get away with, you know, just asking a question at the last minute and resetting our own clock. So we don't give ourselves that luxury. So this is from date of first application, and as you can see, there is hardly anything pending more than 3 months, which I am told globally is just amazing. When I attend the IOSCO meetings globally, they cannot believe that with the number of applications we get, we are able to turn around everything within 3 months. Even the 2 which are pending beyond that are usually for very good reason, either judicial intervention, or we are awaiting regulatory approval from a fellow regulator, or something of that nature. So this is something that we are exceedingly proud of. But again, I worried a lot when I heard Mr. Setty speaking that they now approve SME credit in 15 minutes. I'm thinking, oh my God, we take 3 months to approve a public issue now. We need to really think about how we need to move the needle on this. So I'm sure technology will come to our rescue, and it is already so. A large number of AI-driven projects are already underway within SEBI, and one of the key utilizations of AI that we are deploying is to do faster processing of all applications so that we can turn this around even faster. So hopefully, you know, 1 year down the line, if this chart is being seen, you may see very few yellows as well, and you may see mainly all greens is our hope and our aspiration. You can already see that effect happening in mutual fund scheme applications. As you see, almost everything is in the green. And from where we have come in September 22, when even more than 6 months we used to have applications pending, large number of applications pending for more than 6 months. This has been a collaborative effort by the industry and SEBI to simplify, standardize, harmonize, so that we can get the industry to get on with their business of the markets sooner, and that they don't really have to spend their time engaging with us. Another very important piece, we have, which we track internally, is that when we issue circulars and when we issue regulations, there is a common misperception that, first of all, too much is happening, and also that it is all bad. It is all adding to the cost of compliance. In fact, nothing could be further from the truth. This is for the year that has just gone by, but I must caveat this was an outlier year, and I'll explain why. If you see the investor protection and risk reduction, which usually increases the cost, the requirement of compliance by various entities, it is only 21% of the entire set of circulars. 42% was ease of doing business, 21% was actually to ease the compliance, 16% was market development, which means new products, new channels, new investor categories, and so on. So, contrary to popular perception that all regulation is bad and every circular is only more compliance requirement by the ecosystem, is actually false. Now, as I mentioned, the last year was an outlier year because we had a very, very significant initiative. It was announced by Madam FM in the budget for ease of doing business, and we actually constituted 16 or 17 working groups across every segment of the market to give us suggestions on how to do more ease of doing business. So this proportion, I would say, is an outlier for last year. But in general, if we look at SEBI's pie chart, over the years, the ease of doing business, ease of compliance, and market development has grown and has stabilized at around 45%. So just under half of everything that we do is developmental and ease of doing business, and does not, in fact, add to the regulatory requirements of market participants. So this is something that we're very proud of in last year, and we believe that this helps in the entire process of capital formation. And for us, what is really important is that as we move along this path, just as capital formation is important for the economy and its growth, equally the flip side of the investor, we want that financial inclusion to reach, and which is why the 250 rupee SIP is so important to us, which is due to be launched very shortly. And we want that tomorrow, these young girls who are there studying and looking forward to a future, we hope that their parents will be able to participate in the wealth creation of the nation through the 250 rupee SIP. All of this, over these years, has been possible through one key philosophy of SEBI, which is Samvad. In everything we do, in every single regulation, every single circular that we have issued, there has been consultation, public consultation, stakeholder consultation, all views taken into account, and co-creation of the entire regulatory environment. The latest entrant to that process of Samvad was the Industry Standards Forum, and I'm happy to see Uttam here, one of our key Sherpas, as we call them, in various industry standard forums, where even the modality of complying with our regulations is created by industry. It's not created by us, it's created in consultation with us to make sure it's aligned with the regulation, but is actually created by industry itself. So our belief in SEBI is the reason we have been able to facilitate all of this growth, and the reason that we have been able to participate in this entire growth of the ecosystem and to facilitate the growth of the economy is because of the Samvad that we have had, and therefore it's a very fitting theme for today's, for the next 2 days, and here's to more and more Samvad and more growth. Thank you.
Thank you, ma'am, for sharing your inspiring thoughts with us. Your words have added tremendous value to this symposium and will guide our discussions today. We have with us Mr. Suman Bery as the chief guest. He is Vice Chairman Niti Aayog, a thought leader whose expertise has shaped many crucial policy decisions in our country. It is an honor to welcome you, sir, and we are eager to hear your valuable insights. If you are comfortable, sir, you can sit.
Okay, I'll stop there and then move here.
Okay.
Let me, can somebody make sure this is working before I move across? Shri Ashish Chauhan, Managing Director and Chief Executive Officer, NSE, Shri Sashi Krishnan, Director, National Institute of Securities Management, in absentia, Chairman SBI, Shri Srinivas Sulu Setty, and most of all, Madam Madhabi Puri Buch, Chairman SEBI, the Chief Economist NSE, full-time members of NSE, of the SEBI, distinguished guests, ladies and gentlemen. I am somewhat vertically challenged, but I don't have the, as it were, the flair of Madam in speaking without notes, so I may go back and forth between here and the hand mic. But before I do, one of the reasons I asked for the hand mic was because the acoustics were difficult. It's not important that you be able to see me because you can see me there. But can I be heard from here at the back? It's okay. Well, then maybe it's easier for me to consult my notes here. We have heard a lot about the very impressive achievements of SEBI, of the capital markets ecosystem. The structure of my talk would be, in a sense, to look back, to look forward, a theme that Honorable Chairwoman had raised herself. And I do this because I was privileged to actually be in India as a consultant to the Reserve Bank on leave from the World Bank in the crucial period 92 to 94. I had previously worked on the financial sector in Latin America, and Governor Venkatramanan had invited me to the Reserve Bank because India was at that time moving from the initial 91 Big Bang to financial sector reform. And I think NSC was created in 94. SEBI really gained its stature, and I think maybe even its statutory powers under first, I remember G.V. Ramakrishnan, who was associated with the Planning Commission, where I am right now, and D.R. Mehta, who was a deputy governor. So I have a sense of the extent of the journey and the magnitude of what's been achieved. And let me just say that we talk of Viksit Bharat 2047 as though it's the never, never, but it's much closer to us than, as it were, that Big Bang. And so the question of whether there's a need for a Big Bang, why a second Big Bang, what the elements of that Big Bang might be, would be what I would discuss in the looking forward kind of piece. I think we've already heard about the many successes of SEBI, and I would fully concur with what Madam Chairperson has said, that a culture of consultation has been a very important part of SEBI's success. And I think that is probably unique in the world. But more importantly, I think we should recognize that, and it was recognized in various articles in The Economist, that actually finance is something that India has turned out to be quite good at, as it were. I mean, when I was at the Reserve Bank, the banking landscape was dominated certainly by SBI and the PSU banks. The private sector banks were only slowly given licenses. And now, we all know what our domestic banking system looks like. I don't have to repeat all the achievements of our capital markets. And so, a question that interests me as one from Delhi is whether, in contrast to, say, London, where both the Bank of England and the Securities Administration are in the capital, or Washington, where both the Board of Governors of the Fed and the SEC are located in the capital, whether the distance between Mumbai and Delhi has been one of the reasons for the success of the financial sector. I won't comment on that, but I certainly like to come to Bombay because the atmosphere is quite different here from Delhi. And but frivolities apart, let me just indicate why I, as Vice Chairman of Niti Aayog, I'm very pleased to be here, apart from celebrating the success of the last 30 years. And it links up with the issue of the need or the possibility of a new Big Bang. I think Chairman Setty gave a very detailed account of the need for a step up in the rate of capital formation in order to support the increase in the growth rate that we need in order to achieve the goal. I won't call it a target, the goal. And here I must, coming from Delhi, indicate that the goal is not to be a developed economy by 2047. It is to be a developed society by 2047. And the Honorable Prime Minister is very clear in public interactions and in private interactions as well about two things. One, that growth is a means to an end, and that end is to realize the aspirations, the legitimate aspirations of all of India's citizens, but in particular India's youth. And so it's a means to an end. Second, because this question is sometimes raised, that this is not, unlike a 5-year plan, not a top-down set of aspirations. It's really for all organs of the state, including SEBI, RBI, Niti Aayog, to stimulate a desire and a belief in the population of India that this can be achieved and we must all work towards it. Now, obviously, the devil is in the details, but all I'm indicating is that unlike, if you like, the 1950s, it's not a question of following a blueprint. It is creating conditions for, as it were, the entrepreneurship and the aspirations of young, talented, and, let me say, now much better educated India to take forward in the next less than 25 years now. And so why it's important and Niti to be present at conversations like this is because finance is both very powerful and very toxic, risky, and to make sure that we are harnessing finance for the ultimate ends, rather than it becoming, as it were, as it has become in some of the economies of the West, if you like, a horse out of control. I think that's a very difficult and delicate balancing act that we're going to have to make sure that we articulate. I think we've done a pretty good job. I think our regulators have been ahead of the curve, but the question then becomes, is this at a cost, and what might be that cost? I will raise questions, I won't answer them. So, I've talked about investment finance as being a core part of what the financial system needs to contribute to. But I do want, because these things are probably not as widely reported in Mumbai as they are in Delhi, to draw your attention to very important comments, in my opinion, that the Honorable Prime Minister made at the 100th anniversary of the Hindustan Times in Delhi. I think it was about 6 weeks ago. His point, and that's particularly relevant on the west coast of India, is that India was traditionally a seafaring, risk-taking, trading culture, but that if in the era of central planning, if you will, some of that zeal got substituted by, if you like, a belief that the state would do things for you. He has used, and indeed the late Dr. Manmohan Singh also talked about the transformation of India into an aspirational society, which it is. And an aspirational society is a society of risk takers. And so, in thinking about the role of the financial system going ahead, it's not only, I think, resource mobilization that ought to be concerning ourselves. It is also to back risk-taking, but not at the same time be unaware about the many risks that finance can pose, and also the low level of financial literacy. Now, we have talked about financial inclusion up to now as largely the provision of bank accounts and the Jan Dhan accounts, which I think were a very important part of and really were an innovation in the Indian financial system. I think now we are going to have to, and I'm sure SEBI is active on this, be engaged in very aggressive investor education as the willingness of Indian households to move into the riskier world of capital markets becomes as established a reality as it has. And I was associated with a think tank in Europe, and even in Europe, they are very concerned about, if you like, the lack of financial literacy in their population, and certainly those of us, who have household staff at home, know how parlous and perilous their existence is in terms of safe assets, in terms of scams, etc. This is not particularly about SEBI and the capital markets, but simply to say that as incomes rise, the need for financial literacy and the need to encourage risk and to make sure that, if you like, an excess focus on safety does not push people into even riskier portfolios is something we would need to think about. Now, the one element that did not come across in the discussions was really how much and how quickly India should integrate with global financial markets. And here, the second issue that I also could pose right now, and I'll talk about how we might go about thinking about this, is the issue of what is the blend of capital markets finance and bank finance that India should be aiming for, recognizing that this will ultimately be decided by the preferences of households and by the market. And here I think we have a very interesting contrast between the experience of Europe and to some extent the UK, the EU I should say, and the UK, and the experience of the US. Now there are many ways in which the US is atypical, most of all because it has very deep financial markets and because it is the reserve currency. But it is still intriguing and interesting to know that even though the US has a relatively low household savings rate, that it is very, very well equipped with institutions to provide risk capital, hedge funds and early stage venture capital, etc. And I think for the kind of entrepreneurial society that we would wish to become, there are capital markets will have and are playing a very important role. On the other hand, Europe, which has traditionally been a bank-dominated system, has found it very difficult, even though they have the latent entrepreneurs, to come up with the financing structures that are appropriate. So I think talking about the next big bang, having a view on what the right blend and balance should be going forward is something that the system needs to think about. I don't know what the right way is of going about this, whether to commission an expert group or something like that. But I think that's one of the strategic issues going ahead. And Niti itself has been working with some of the people here as part of its overall work on climate change in trying to get a sense of where the financing is going to come from. To return to the issue of that I raised about integration with global financial markets, how do I see it? First, it should be, and this is another another formulation of what sometimes is called capital market liberalization. In lots of ways, we started down that path, indeed, in the first Big Bang, when we cautiously allowed in foreign portfolio investors, and they've become, with some hiccups, the whole issue of participatory notes, etc., they've become a part of the Indian landscape. But at the end of the day, there are economists who argue that we maintain capital controls at the moment, partly to as a matter of financial stability, but partly also in a way as a form of financial repression, so that there is a guaranteed market for government debt. I think that may once have been true, but I think that if we are to go down the path that Madam Chairperson articulated about a vibrant corporate debt market, a second balance that we're going to have to get right is between corporate debt and government debt, and exactly what that takes in terms of both fiscal adjustment and in terms of the liquidity in the corporate debt market. These are issues that we've been exploring at Niti. So this program has been impressively on time, and I'd like to end at 10:45, which was the allotted time. So let me just make some final comments. I've tried to argue, perhaps not too coherently, that while there is a lot of uncertainty in the world today, there is also considerable appetite for risk, particularly among India's investors. This has been exhibited in derivatives markets. It's also exhibited in the embrace of crypto, etc. And so actually creating a culture where people are allowed to make their own mistakes, and we learn from them without smothering, as it were, risk-taking behavior. I wouldn't know how to do this, but I do see it as an issue, is an issue on the agenda. Second, that India has depth of financial talent, and the development of that talent could well be an increasing source of engagement with the rest of the world. As it is, much of the financial talent in Singapore, Hong Kong, London, New York actually is expatriate Indians. And so I don't know whether that can somehow be mobilized. And that, if you like, sandbox type arrangements might be used, and the Reserve Bank has used them extremely well, I know, in exploring CBDCs and payment systems, but it may be, and I'm not aware of the extent to which this is a practice in capital markets. And that finally, if you like, India could end up being a very important and a very interesting blend between a banking-dominated system and a capital market system, and that some thought may need to be given either in discussions like this or in Delhi about where we want to get to and why. So with that, again, thank you for giving me the opportunity. A Diliwala in Mumbai, although I should say that my background in Mumbai is at least as deep, and I wish the rest of the proceedings every success. Thank you.
Thank you so much, sir, for your enlightening words. Your insights have provided us with much to reflect upon as we delve deeper into today's discussions. I now have the pleasure of inviting Mr. Tirthankar Patnaik, Chief Economist, NSE, to deliver the vote of thanks.
Thank you, Dipali. Ladies and gentlemen, as we conclude the inaugural session of Samvad, the Symposium on the Securities Markets. It's my privilege to deliver the vote of thanks. First and foremost, I extend our deep gratitude to our chief guest, Dr. Suman Bery, Vice Chairman of Niti Aayog. Your insightful address has set an inspiring tone for our discussions and encourages us to think boldly about the future. We're also very grateful to SBI Chairperson, Setty. Your keynote address was not only enlightening, but also a powerful reminder of the synergy needed between the banking and the securities market. I would like to express our sincere thanks to SEBI Chairperson, Madam Madhabi Puri Buch. Your dedication to fostering a transparent and robust regulatory framework is vital for the integrity of our markets. The insights you shared today will undoubtedly guide our discussions as we explore the challenges and opportunities that lie ahead. I extend our gratitude to NISM Director, Ashish Chauhan, for the opportunity to host the conference at NSE. Your opening and thoughtful remarks, very thoughtful remarks. I also like Naval Ravikant a lot, have laid a strong foundation for this symposium. I'm very grateful to Shri Ashish Kumar Chauhan, our Managing Director and CEO, for his support and guidance. Your leadership and vision for the National Stock Exchange plays a pivotal role in shaping the landscape of the securities market in India. Your ongoing efforts to promote innovation and transparency are essential to our growth as a community. I also thank the organizing teams at SEBI, NISM, and all the MIIs for their meticulous planning, tireless efforts, and unwavering dedication in bringing this conference to a fruition. I'm extremely grateful for all the cooperation we receive from our colleagues at NSE, various departments, for ensuring smooth logistics and technical support. I would like to express our sincere gratitude to all our participants here in the auditorium and the boardroom and online for their overwhelming support and enthusiasm. We're thrilled to have over 300 participants, as Madam Chairperson said here, for attending the symposium in person. We had to add many more chairs on the other side, and an even greater number joining us virtually. Your involvement through the day makes this conference truly special. I also thank the media for being here for all the 2 days. Thanks for covering us. Let us carry the insights gained from this session into our forthcoming discussions and continue to build on the foundation that we have established today. I hope, ladies and gentlemen, you will find the takeaways useful from this conference. I would now request our Managing Director to present the commemorative photograph that we took at the inaugural session to the dignitaries on the dais. It is accompanied by our coffee table book, which commemorates 30 years of the NSE. With that, we come to the end of the inaugural session. We break now for a short break. We resume at 11:15. Or 11. Yeah, 11:15.
Good afternoon, ladies and gentlemen. Welcome to our first episode of Market Masters in the new year. And we are blessed to have a very fine gentleman who really needs no introduction. Mr. Samir Arora, founder for Helios Capital, joins us from Singapore. Mr. Arora is a very, very well-known investor in Indian markets and is able to time the market in a very fantastic fashion and explain the inexplicable. Namaste Sameer ji, a very warm welcome to you. Happy New Year. And what a way to start January. I think the market is saluting your presence on Market Masters with crossing 24,000 on the Nifty.
Thank you very much and Happy New Year to you, both of you, and to your audience. And if the market is going to welcome me like this, then every day put me down as one guest.
We will be more than
बस
blessed.
ये हमने लिख के रख लिया है समीर जी और and we will take an in cash